Chapter 7 now, dealing with budgeting. I did not embed the questions into the lecture because it makes more sense for us to get the macro view of how we would look at the budget, and then we'll start to take a look at some quiz questions. We'll go through a few of those because I want you to work those directly, and so you should be looking at those for homework over the weekend, and then we'll go through those on Monday and jump ourselves into Chapter 8 after we've gone through the quiz in the second half of the class. Budgeting is something that is much more of a hands-on process, and you could sit here and watch me go through these questions and go through these slides all day long, and you don't start to realize really how easy this all is until you start going through the process of working through these questions. What you're going to find is that, in my opinion, we're not testing your accounting knowledge at all. We're testing your reading comprehension more than anything, when you can look through a fact pattern and determine how we're going to come up with. And we start the process with the sales budget. Sales budget drives our production budget. Production budget drives our, well, sales budget drives our cash receipts budget. Then sales drives our production budget. Production budget drives our purchases budget. Purchase budget drives our, then we have to figure out our labor cost, our overhead cost. All of that drives our cash disbursement budget. Cash receipts versus cash disbursements is going to determine our financing budget. How much do we need to borrow, etc.? What cash surpluses will we have? And sort of the back end of the whole thing is a set of budgeted financial statements, which the master budget project is really intended to get you to where you go ahead and you prepare a set of budgeted financial statements. I'm not going to hold you accountable to that. We'll still do the points on that, but I'm not going to require that in this class. Okay? So that's where we're going with this whole process. Now, whether you're determining that your life's work is going to be that of an accountant or not is really not that significant to your understanding this budgeting process, because what I can promise you is whatever organization you get involved in whatever capacity you get involved in, at some point in time that entity is going to be expected to come up with a budget, and when the process hits, almost everybody gets involved in some aspect of preparing their portion of the budget, their department's part of the budget, your team's part of the budget, whatever it is, your budget for a particular project that you're working on. There at some point in time, someone's going to ask you to, hey, can you throw together some budget numbers so we know, what this project, what this particular department, whatever is going to cost us, okay? I had a former student at SF State that said to me, I was so glad I took your class and that you walked us through the budgeting process, because I got an internship with the Giants, and the first thing they asked me for was, hey, can you help out with the budget process, right? Okay, so this is something that at some point, if you don't learn it now, you'll be learning it later, so you might want to go ahead and make some forays into it now, obviously for your test, etc. But save this information, understand this information. It's going to be useful to you in the future. Okay? So when we take a look at budgets, the process of preparing the budget is called budgeting. And what we are trying to achieve here is budgetary control. Once we have established this budget, we're going to put the expectation on our operating departments that they, of course, will live within their budget. Okay? And so what's going to happen? We are going to use it for planning. We're going to use it for control. This is a bit over the top, this guy with the whip, but whatever. We're going to use it for control here, and that we're going to judge performance depending on how individuals do against their budget. And when we start getting into our analysis, our variance analysis later, we're going to see that we will call those variances either favorable or unfavorable depending on how they're working against the budget. Okay? Okay, good. We also have something called responsibility accounting. And what happens with responsibility accounting is we only hold those individuals accountable to costs that they can actually control. For example, if you are a new manager to a department, are you responsible for the depreciation on the building that that department resides in? No. How can you control that? How is that your responsibility? That building was purchased, and they told you, hey, go run your production out of that particular building, right? So since you can't control that depreciation, depreciation is not something that we would conclude as part of your performance budget, right? Typically, we look at variable costs and not so much our fixed costs when we're analyzing how someone's performing against their budget. Okay? Okay, good. So, we're going to be talking in this chapter about the operating budget. And you can see here that an operating budget typically covers what? A year's worth of time. And we'll really put this thing together by quarters. So we'll sit here and we're going to be, in this example, I think looking at the third quarter of the year or second quarter of the year in this little example. Okay, so we typically do this by quarter, but we're just saying that these are operating budgets. Operating budgets cover the course of a year. When we start going beyond 12 months, that starts to get into capital budgeting decisions. Now you say, well, what do you mean beyond? What kind of decisions go on beyond 1 year? Well, that's when we start making decisions about whether we should purchase a particular asset, rent that particular asset, should we sell the old asset or keep it and purchase something newer. But those are decisions that are going to impact more than the current year. We call that capital budgeting, and we get into that to like the last couple of chapters. So in this chapter, we're talking about what? Operating budgets. We're talking about those that occur over the course of a year, shorter term decisions, and again, we're just going to focus in on what? A quarter at a time, and in this example I think that we're going to use here, we're going to focus in on the second quarter of the year, I think is what it was. Okay? Now, they talk about budgeting. They talk about it including all levels of the organization. So you see that they're starting with supervisors, but supervisors should be getting input from those that they supervise, right? And then what? That then is going to feed up to middle management and then ultimately get to top management. And the middle and top management are going to look at those budgets, and we're going to see for something called budgetary slack. Okay? Now, when we talk about motivation, okay, we want to make sure that the budget is going to be realistic. It has to be attainable. Okay, it has to be attainable. Now, if you make it unattainable, people are going to say, well, that's just impossible. We're not going to do that, right? And we're not going to even try to achieve that. I mean, this is all sort of, arguing with itself, because then they say, well, if you have self-imposed budgets, top management should look at that and they should review it for any budgetary slack. So what's going to happen? The people at the lower level, whatever, that actually have to accomplish the budget are going to put it in a manner that they think that they can accomplish fairly easily. And then the top management is going to look at that and say, well, there's budgetary slack here. We're going to squeeze the budget. They're going to push that back down to the lower levels, and the lower levels are going to say what? That's impossible. We can't do that, right? Okay, so we end up there anyway, but they're describing sort of a pie-in-the-sky process, and maybe the reality is that the politics of the whole thing eventually gets it to maybe where it's a little bit more realistic, but as you know, politics in any situation. Sometimes I hear people say, I hate politics. And I'm like, I think to myself, so you're telling me you hate life? Because life is politics, right? It's a give and take on many different levels. I don't care if you're talking about your day-to-day house. I don't care if you're talking about getting on the bus this morning. At some point in time, politics took over, okay? The only place that you don't have politics is what? When a mosquito flies into your house, okay, it's either you or it, right? Then there's no politics, right? But other than that, there's always politics that go on back and forth between human beings, okay? Okay, good. So we come over and we take a look, and of course we want people to be enthusiastic and committed, etc. All, sort of making boxes lighter type of stuff, okay? All right, so let's just go ahead and let's talk about the process here. And we start with The sales budget. Sales budget drives everything, right? We want to know what we want to sell, what's going to happen. We're going to have to then produce those items, aren't we? So sales budget will drive the production budget. And of course, we have to sell this stuff, so we'd probably have an advertising, and you can never get away from what? Administration, that sort of thing. So of course, those are going to be there. Once you have your production budget, what are our production costs? You shouldn't even have to look at this, our materials. What is it that they say? I shouldn't even have to ask, right? What's in your wallet? I shouldn't even have to ask. I shouldn't even have to ask that what? You know what the production costs are, materials, labor, and manufacturing overhead, right? Okay? And so what's going to happen? That's going to drive our budget, and then what? We are also going to want to have a little ending inventory. So this is work in progress, and this is thinking about what? Finished goods, and of course, we'll have our cost of goods sold for items that we don't, that we actually sell during the period. And then what? Then we have our cash budget. Once we know what we're going to be taking in sales, we know what our cost of production are going to be, our materials, our labor, our overhead, sufficient to do what? To meet our sales, to meet our desire for our ending inventories, right? Then what? Then we'll know what we have to spend. That gives us our cash budget. And then, again, as I was saying, almost a byproduct of this budgeting process is these budgeted financial statements. So you kind of look at this and you're thinking, gee, this must be the big payoff and the whole reason we're doing this. Not so much. Planning, control, yes. And what? The budgeted financial statements are simply a means of communicating the budgetary decisions that we've made, right? Okay, so we'll see how those will come together. On your exam, guys, I'm going to hold you accountable right up in here. I am not going to be having you pull a set of budgeted financial statements. That was sort of what was behind that project, but we're not going to get into that. Okay? Okay, good. So let's just go ahead and let's start looking at some expectations here. And I'll tell you what I'm going to do, because we keep kind of coming back to our sales budget. And so what I want to do is just write this up on the board so that we can remember what it is that is driving everything we do. And notice they're describing this sales budget in terms of the number of units, right? What are the number of widgets we're going to sell, whatever, right? And we're going to be doing this budget for the second quarter of the year. Second quarter of the year is what? April, May, June are the 3 months that constitute the second quarter, right, of the year. Okay? And they're showing us that they want to produce 20,000 units in April. They want to not produce but sell 50,000 units what? In May. In June, they want to sell 30,000 units. Now, they also give us July and August up here. And I'm not exactly sure why they're giving us August. But July they're giving us because we're going to see that one of the constant themes here as we look through this is that we're always going to want to have some units left over at the end of the month to get us started into that next month. So at the end of June, we're going to be concerned about what? Do we have enough units left over to start our processes in July? So July will be significant, or not significant, but relevant to this discussion. And then for some reason they give us August. I really can't tell you why, but let's just write it down here. Anyway, 15,000. Okay? Okay, good. Now we take a look, and the selling price is $10 per unit. So we can pretty easily come up with our sales budget, don't you think? Okay? And God made Excel for these analysis, for this type of analysis, right? Because we're going to come down and you're going to see this is an Excel format, obviously. And we have what? April, May, June, that second quarter, the number of units. You see them up here on the board. You see them up here on the screen for those 3 months, the second quarter of the year. And we just simply multiply that by $10. Can you figure out the sales budget easily? Got our sales budget here. It took us 2 minutes, right? Okay. Okay, good. Now, of course, the hard part would be figuring out the number of units we think we can sell in each one of these months, okay? But once we got that from an accounting standpoint, we could then drive our sales budget, okay? Okay, good. Then what? They tell us now that we want to get the cash budget. And of course, not all of our sales are cash sales, so we have to understand our collection pattern, our collection flow. And they tell us that 70% of the sale is collected in the month of the sale, and then 25% is collected in the month following the sale, and then they tell us that 5% is uncollectible. Now, what I have seen that a lot of students get confused on is they want to subtract that 5% from what's going to be the sales. That's not how you do it. You simply look at what you're going to collect. So that 5% that you're not going to collect is pretty much written off, ignored. You're just going to assume that you're not going to collect it, right? Okay? So we go ahead then, and they tell us that we had a beginning balance ending March 31st is April 1st beginning balance, and they're going to say that that beginning balance April 1st 30,000, that all of that got collected in April, so we're going to go ahead and add that to the April's collections, right? As well as what? As well as 75% of April sales, right? Okay, so let's go ahead and let's take a look at April. There's that 30,000, right? That was the 331.41 beginning balance. And then we had sales of 20,000 units, $10 a unit, 200,000 of sales in April. And we're supposed to collect what? 70% of that in April and 25% of that in May. What about that last 5%? Shouldn't we subtract it? No, we just don't add it in as a collection, right? And they're not going to collect that. Okay? You see why I'm telling you this is a reading comprehension exercise more than it is a counting exercise? Okay? Then what? Then you go ahead and you look at May. May, 50,000 worth of units being sold, $10 a pop. That's 500,000. 70% gets collected in what? In May. That goes along with the 25% from April to get our May total. And what? 25% will get collected in June, right? Then you go over to your June sales, and when you get into June, now what? 30,000 units, $10 a pop. That means if we collect 70% of that, we're going to get 210,000 in June for the June sales. Of course, the remaining 25% is going to be in July, but we're only doing this first quarter, right? April, our second quarter, April, May, June. Okay. Question on that? Okay, so we've got although the production and cash disbursements budget is much more involved, but we've got the first major piece of this, which is what? The cash collections, right? Cash collections, cash disbursements. That's going to tell us whether we're going to have a cash shortage for the period, meaning that what? Meaning that we're going to have to go ahead and borrow, or if we have a what? Cash overage. And we don't get into it in this example, but we may literally decide to start making some investments, right? If we start having enough cash surplus sitting around, we may actually decide to make some investments, etc. Okay? But anyway, we'll see that down the road. Right now, we've got our cash receipts. Okay? So we come over, and we're going to go ahead and figure out our production budget. Production budget is going to drive our cash disbursements budget. So let's go ahead and let's see now. We go on to our production budget. Got the sales budget, cash collections. Let's go ahead and do production. Okay, and again, I think I stuck this in here again. I'm not sure that the book had originally contemplated it, because the biggest problem I have in this example is I keep forgetting how many units they said they were going to produce each month. So that's why I wrote them up here on the board, and I keep putting this slide in here, right? So that's the units we want to produce. So we go ahead, and they tell us that they want 20% of the following month's budgeted sales in units available. In other words, what? They don't want to start the new month with zero of inventory, because what if somebody walks in January 1st and says, I want one of those, and we ain't got it, right? So what are we going to do? We're going to have at least 20% available then to give us time to continue to add on to that, so that as we get customer orders, we can fill them, right? Okay, so they want 20% of what they'll need to meet the following month's sale available at the end of the current month. And they tell us that there were 4,000 units on hand. Hey, and that works, doesn't it? If there were 4,000 units on hand and they want 20% of the next month's sales, did they achieve their objective? 20% of what? April was 4,000, and to start April, they had 4,000, didn't they? So they accomplished what they were trying to here? Okay? Okay, good. So we come over, and by the way, this is a textbook. It's not like you're always going to have 4,000 units. You might have a little more, you might have a little less, but you want to be hovering around whatever you've determined your target number is, right? Okay, so we're going to go ahead and have this 20,000 times 20%. We have these 4,000 units, okay? So we start the month with that, and then we're going to say, and this is the way I do these, guys, and you're going to see some questions like this in the homework. I set them up just like this. Budgeted sales, 20,000. We know we need 20,000 units if we're going to sell 20,000, don't we? Right? Then what? Then we go ahead and we say, well, what do we want as our ending inventory? We know we want as our ending inventory what? 20% of the next month's sales, don't we? So if the next month's sales is 50, 20% of 50, we want 10,000 left over. So we have what? Total needs of 30, but we covered ourselves by having 20% of the April sales. We've got the 4,000 there, don't we? So we can subtract those off. So we actually need to produce what? Not 30,000, but 26,000, because we gave ourselves a 4,000 head start, didn't we? Okay. Okay, good. So we got April. We go ahead and we do May. What's happening? We've got what? 30,000 units we want to sell in June. We want 20% of that. 20% of 30,000 is what? 6,000. We know we want to produce 50,000 to sell 50,000, right? So we have total needs of 56, and then what? And then we started the month with 10 because we gave ourselves a head start, so we need to produce 46,000, right? Okay. Then what? Then we go ahead over to the next month, and what happens? We wanted to produce 30,000 to meet our sales for June. We want 5,000. I don't know why they said assumed ending inventory here, because it makes it sound like they pulled it out of you-know-where, somewhere out of the air, whatever. And I look at that and I'm like, well, wait a minute. We're saying that we want what? 20% of the next month, don't we? Hasn't that been the mantra? 20% of the next month. So if my next month is July and I was supposed to have 25,000, 25,000 times what? 0.20 would have given me this 5,000, wouldn't it? So they say assumed, and I got to tell you guys, I looked at that and I looked at that and I'm like, well, am I missing something? Did they say something somewhere else? I don't see where they got that we have to say it's assumed. Okay. Now, a caution note about this quarter total. Okay. And so, well, let me finish June first. So we got the 5,000. So we have total needs of 35, and then we started the month with what? With 6,000. So we only need to produce 29,000 for June, right? Right? Okay. Now you come over and be careful with the quarters. It's not as easy as just adding across, okay? It works for what? It works for the budgeted sales, but you can't add across here for the what? For the desired ending inventory, because it's the desired ending inventory at the end of the second quarter is the desired ending inventory at the end of June, isn't it? Because June marks the end of the second quarter, okay? And then what? For the desired ending inventory, you can't add across because what? The desired ending inventory for the end of the second quarter is the desired ending inventory at the end of June, and the desired beginning inventory was your desired beginning inventory for the beginning of June. I think I said the end of June, for the beginning of June, right? For the quarter. Okay, so June marks the end of the quarter, right? So if I wanted 5,000, come on guys, don't overthink this. If I wanted 5,000 units to be available at the end of June, then my desired ending inventory at the end of June, oh, I see why you guys are looking at me confused. I said it wrong. Your desired ending inventory at the end of June is what? Is the desired ending inventory at the end of the quarter, right? The what? Beginning inventory on hand at the beginning of the quarter here is what you had as your beginning inventory at the beginning of April, right? Okay, that's just given. My point being you can't add a cross there. Okay, not the beginning of June, but the beginning of April. Okay, question? Okay, good. So let's go ahead then and let's take a look and see what our cash disbursements are going to be. Okay, so when we look at our cash disbursements, okay, they tell us that we're going to have to then get the materials, right? Then we're going to have to pay for the labor to produce these units, and we're going to have to figure out what our cash overhead is going to be, right? Okay, and the reason I'm emphasizing cash overhead, and this is going to be an important point, some of our overhead doesn't use up cash, now does it? For example, our depreciation is not going to use up cash, isn't it? So we're going to have to make an adjustment there for our non-cash overhead items, okay? So let's start with materials. 40 cents per pound of materials we need. We're going to need 5 pounds for each unit, and we want to have 10% of the materials that we need to cover our materials needs available at the end of each month. Okay, so we go ahead and we come up with these numbers: 26,000, 46,000, and 29,000. That came from where? That came from this slide, our production budget, didn't it? Right, so we know how many units. Now we're going to turn those units into what? Into pounds of material, aren't we? Okay, so since it's 5 pounds of material for each one of those units, then we have the total total pounds, I should say, of material we need, right? They tell us that we pay how much per, well, we don't do the calculation of how much per yet. We have to figure out that's our total needs, our total production needs, but then what? We want, and it was 10% of the next month's material needs on hand at the end of the previous month, right? So 10% of this 230,000 gives us this 23,000. Now we have our total needs, and they were saying that what? There was 13,000 on hand. Why was there 13,000 on hand? Because we had our production need of 130 for April, so we made sure we had 10% of that 13,000 on hand at the end of March, right? So we started April with that. So you subtract that off, and our total materials to be purchased are what? Are 140. Okay? We go ahead and we do the same thing with May now. We know we need at least 1030, and then we're going to want what? 10% of our June needs. We're going to add 14.5 onto that, aren't we? Right? But then we'll subtract off what? We'll subtract off the 23,000 we would have had available at the beginning of May, right? End of April. Okay, so sure enough, that's what happens. We have what? We have the 14,500 that we wanted available to help meet our June, 10% of that. And that gives us our total needs minus the beginning inventory. So this is just a what? A reiteration of what we said for the units, isn't it? But now we've just simply multiplied it by pounds. Okay, so we've turned our units into pounds. Now, you come over and they go ahead and they get us into June now. We're going to produce 29,000 units, 5 pounds per, and then we have a desired ending inventory, and for some reason they came up with 11,500. 11,500 does not make sense to me, because if I'm sitting there and I'm doing what? I'm producing How many units in July? I'm producing 25,000 units in July, and if I need 5 pounds of this stuff, July is 25,000 units, and I need what? 5 pounds of this stuff? That comes out to what? 125,000 pounds? And if I take 10% of that, that, by my calculation, comes out to 12,500. So I can't tell you why they're telling you that they're going to have a desired ending inventory of 11,500. If I'm reading the, specs correctly on this, they should have been saying they need 12,500. I can't tell you why they just jumped out with that number of 11,500 other than, I don't know. Because they know that it doesn't tie to the example, because I think that's why they said the assumed. So I don't know. Maybe it didn't tie into something else they wanted to do later in this problem, so they just threw that number in there. Okay? Okay, so I think it should have been 12.5. They didn't put 12.5, they put 11,005. I can't explain it. I've looked and looked at this 90 times. And then you say, well, John, why don't you just change that? Because then if I do, then it changes the whole rest of the example, and I just don't have, life's too short. Okay, so just use that number, 11,500. That doesn't destroy the nature that what? We would take whatever the desired ending inventory is, however we came up with that. That gives us our total needs minus what? Minus our beginning inventory gives us our materials, I should say, need for that next month. Okay? Now, they told us we pay how much per? 40 cents per. So we turn those pounds now into what? Into dollars, and that's going to help us to figure out our disbursements, isn't it? Okay. Now, in this problem, they tell us that there was 12,000 accounts payable at the beginning of April that we're going to pay in April, and then what? They tell us that half of the month's purchases is paid for in the month of purchase. The other half is paid what? In the following month. So again, we're trying to figure out what our receipts and our disbursements are month by month, aren't we? Okay, and that's going to help us to figure out what's going on for the quarter. 4 quarters turn it into a year, right? Okay, so we go over and we take a look, and they tell us that we have accounts payable to start the year for 12,000. And then I just went ahead and kind of superimposed this up here, just cut and paste from the previous slide up here in the heading. And all I'm showing you is what? We have 140,000 materials to be purchased, and 140,000 times what? Times 40 cents per unit gives us this what? This total 56,000, right? 140,000 times 56,000, of which half will be paid in the month of purchase, half in the next month, right? Okay. Okay, good. Then we just go ahead and we do the next month here. We are going to collect the remainder of the April in May. And again, we had what? We had this 221,500 times what? Times the 40 cents gives us 88,600, half of which will be collected in May, half of which will be collected in June, right? Okay. Right? And then we go ahead and we take this, what, 142,000 times what? Times the 40 cents gives us 56,800. Half will be collected in June along with the rest of the other half of the, not collected but paid. Not collected but paid. We're doing our cash disbursements budget. So half will be paid in June and from the May, and then what? We'll pay half of June in June, and the other half will be paid in July. We're not worried about that right now because we're doing what? We're doing the first quarter, right? So we don't have to worry about July for this problem. I mean, we're doing the second quarter. We'll do that the third quarter for the third quarter. So we're not worried about that for this process. Okay? Question? Okay. Okay, good. Now, obviously, what? Just thinking about Excel again, you'd probably only have to set this thing up one time, right? And then what? Then you would simply just extend out all this logic across the different quarters, right? Okay, and then you might make little adjustments for anything that happens seasonally. Okay, so we go ahead and we have our cash disbursements for our materials. Do we have to spend any more money to produce our product? Like, here comes the labor, right? Okay, so yeah, exactly. So you're anticipating what's coming next. Here comes our labor budget as we pay the employees. Okay, so we take a look, and they tell us that we have a 40-hour work week. We pay what? $10 per hour. Okay, but they say they're so generous, this company, they pay their employees $10 an hour, and they're so generous is they guarantee them a minimum of 1,500 hours per month. So, I guess they figured we shouldn't treat them completely like slaves. We're already paying them $10 an hour, but we might as well do what? At least guarantee them so that they don't get all the way to work and we say, go home. There's nothing for you to do around here today, right? So we go ahead and we at least let them work that 8 hours for that day. So we guarantee them the 1,500, right? Now, when you look at something like this, when we take the labor dollars, okay, it's either going to be the actual hours or what? The guaranteed hours, whichever is greater. It's going to be either the actual hours or the guaranteed hours, whichever what? Whichever is the bigger number. Because if we're under the guaranteed, we're still going to pay them the guaranteed, right? If we're over the guaranteed, then we're going to pay them per hour that they've worked for the period, right, which would be over the guarantee. So let's just look at the examples. It'll be clear to you how that's going to work. So we first sit there and say, well, how many labor hours do we need per unit? And I guess we need to go back. And the problem told us what, 0.5? Okay, 0.05, 3 minutes per unit. Geez, what are they making here? Spit? Okay, so it's what? It's 3 minutes per unit. Okay, so we go ahead and we take this 26,000 and it's what? Direct labor per unit is going to be 0.05 of an hour, 3 minutes. So labor hours required is 1323, 1450, or for the quarter 50/50, right? Okay. Now you come over back and we said it's a minimum of what? 1,500 hours, isn't it? So for this first month, where we're April, where we're saying 1,300, what number are we going to use there? We're going to use 1,500. Good. For May, it's 23. What are we going to use? 23. And for June, we're going to use what? 15, right? Okay. So sure enough, that's what they do. 15 for what? For April, even though we were under 15. 23 because the actual was bigger, wasn't it? Okay. And then what? And then when we say actual, what they actually expect. Because right now we're still preparing a budget, right? Okay, but what they actually expect is greater than the guaranteed. So we take that. And then again, we take the guaranteed if our expected actual is under the guaranteed. Okay? All right, we go ahead and multiply that by the whopping $10 per hour. And that gives us our labor cost, right? Do you want to work in this place? I don't want to work there, $10 an hour. That's crazy. We're going to send Bernie Sanders over there to yell at him, right? Okay. So we just go ahead and we do we add up all of these hours, right? All these dollars by getting the hours. Okay, so we've got our labor, we've got our materials. Now we need our overhead, don't we? Our 3 factors of production, our 3 stooges. Okay. And so we come over and we take a look now, and they tell us the variable manufacturing overhead rate is $20 per direct labor hour. We have fixed manufacturing overhead of $50,000, but only what? $30,000 of that is actual cash. $20,000 is non-cash overhead. Example are what? Our factory depreciation, right? Our factory on our equipment, our factory building, whatever, right? I mean, our depreciation on our equipment, our depreciation on our building, whatever, right? Okay, so let's just see how we're going to handle that, because remember, we are preparing a cash budget, right? Okay, so we come over and we have our budgeted direct labor hours, either what we actually well, actually, I guess it is what we actually worked here, right? It is not the guaranteed. It's based on what you actually are thinking you're going to incur, right? So that's an important takeaway here. It is not the guaranteed. It is what you actually work, because we're applying it based on the hours that they actually worked, right? So we use that. We multiply that by the $20 per hour, okay? And that gives us our variable manufacturing overhead. We add in the fixed, okay? And when we do, notice, guys, this can be now our predetermined manufacturing overhead rate, can't it? Because we know what? We know the number of hours now, and we know the total cost associated with that. And so we can come up with our predetermined manufacturing overhead rate at this point in time that we could then use for that quarter, right? Okay. Okay, good. Then we go ahead and we take out the non-cash, the depreciation. So now we've got our cash disbursements for our overhead, don't we? Okay. Okay, good. Then what? Then we go ahead and this is sort of a little sidebar where they're going to figure out the cost per unit. Okay, the cost per unit is our direct materials, which is $5 per pound. 5 pounds of the material at $40, because it's 5 pounds of material for each unit times 40, not $40, but 40 cents a unit. So that's $2 per unit, 40 cents per pound, I should say. That's $2 per unit. Then we have what? Our direct labor, 0.05 for each unit times $10 an hour. That gives us 50 cents per unit. Our manufacturing overhead that we just calculated at what? 49.07, and so that gives us this 249. And so we have a per unit cost, don't we? And so if we want to budget our ending inventory, we would simply take this 4.99 times the number of items that we think we're going to have in our ending inventory. And remember, we want to have 5,000 units at the end of the first quarter. That will be our start on our 25,000 units of July, the 20%. And so that gives us a value for our ending inventory of 24,950. Now, the only reason they're doing this little sidebar at this point is when we prepare our budgeted financial statements, aren't we going to have to report inventory on our balance sheet? So this gives us the number that we'd have to stick in for our inventory on our balance sheet by doing this. Okay? Okay, good. Now we come over and we have to get our selling and administrative budget now. So we've got our, I kind of went on to this next slide without trumpeting that we have our product costs now, don't we? We have what? We have our materials, we have our labor, we have our overhead. Now we're going to selling and administrative, aren't we? Okay, so when we go to our selling and administrative, we have a variable selling and administrative of 50 cents per unit sold. We have our fixed of 70,000, and once again, they tell us that of that 70,000, there's a $10,000 portion that is a non-cash. So now we can go ahead and do our cash selling and administrative budget, which is by taking our what? Budgeted sales of 20,000 units times what? Times, they told us, 50 cents per unit. That's $10,000 plus our what? Plus our fixed selling and administrative. That gives us the total minus what? Minus our non-cash gives us the 70,000 cash that we will need for our administrative budget. We do the same thing with May and June, right? So now we know that we're going to spend what? Notice, guys, on an accrual basis, our total selling administrative is what? 260, but when you take off the cash, we have what? We have, the non-cash, we have 230 as our cash selling administrative. Okay. Okay, good. So let's go ahead then and let's prepare the cash budget, and it's a piece of cake now. We have our cash receipts. That was our sales generated the cash receipts budget, right? We have our cash disbursements because we've looked at what we're going to spend on materials, labor, and overhead, right? So we've got that, and our selling and administrative. And then we're going to see if we have a cash excess or deficiency. If we have a deficiency, we need to borrow money. And that will lead us to our financing section. This example doesn't get into it, but if we started to build up a significant surplus of cash, then it begs the question, what? What sort of investments are we going to make, right? Maybe at some point it makes sense for us to acquire our supplier, right? We've got this major supplier that we're using that's supplying all of our goods, and we look at that supplier and we're saying, hey, that's a pretty good little business that's going on over there. Why don't we go ahead and do what? Acquire them, right? Merge with them. So we do some sort of vertical acquisition like that, right? Okay. Okay, so we go ahead. And we're not going to get into the investing, but we are going to see what's going to happen with some borrowing when they have a cash deficiency. Okay, so let's just go ahead, and guys, this is like just detailed to get you through this whole process. We maintain a 16% open line of credit for $75,000. Look, this is highway robbery. This is usury these days if they're charging you 16% interest for an open line of credit. But okay, we're not going to argue with the problem. If they want to charge us 16%, that's not fine. We would find somebody else to loan us money. But let's say that's the fact. Here we have to deal with it. Maintain a minimum cash balance of $30,000. We don't want to be bone dry of cash down to zero at the end of any particular month, right? We borrow on the first day of the month and repay on the last day of the month. We pay a cash dividend of $49,000 in April. And we're also going to throw in this, so I guess this is investment, part of it. Investing in what? Equipment. And we're going to purchase equipment in May of $143,700 and in June of $48,300. And we started the month of April with $40,000 cash. Okay? So we go ahead, we start the month with $40,000 cash, and then we take our cash collections. Where did that come from? That came from our cash receipts budget, right? That we had done earlier. Okay, so we've got our cash receipts. That gives us our total available less what? Less and there's our materials, there's our labor, there's our what? Our cash portion of our manufacturing overhead, our cash portion of our selling administrative. So we've got our cash disbursements here for our operations, don't we? Right? And then they decided to pay a dividend of $49,000. If you pay a dividend of $49,000, cash dividend, that's going to be cash going out, isn't it? And when they do that, and this is kind of a dumb example, maybe they made this dumb just so I would make sure and point out to you that this would be the most ridiculous business decision in the world to pay out a dividend and end up with a $20,000 cash deficiency. So, I mean, that is almost becoming a loan to the shareholders at that point, because now we're going to have to pay that money back and we're going to have to pay interest on that, right? So I highly, highly doubt that a company would make the silly decision to pay a cash dividend that's going to throw them in a cash deficiency, okay? But let's just humor the example. We go ahead and we want to pay a cash dividend, so we're going to end up with a deficiency of $20,000, right? And we want an ending balance of how much? $30,000. So we've got to borrow now $50,000 to pay out a cash dividend of $49,000. How stupid is that? So we basically just borrowed the money to pay a cash dividend, which is not the point behind a dividend at all, is it? Okay, the point behind a dividend is, hey, we've got excess cash and we don't have any, investments or other uses of the capital at this point in time, and so it's time to harvest and pay out a dividend, right? Okay, but anyway, that's okay. Just live with the problem. The important thing is what? That we know that we had to borrow $50,000, right? And we borrow money, we said, at the beginning of the month. We pay back at the end of the month, right? So we're borrowing this money on April 1st, and it's a what? It's a 3-month loan. And so we're going to have all of April, all of May, all of June. We're going to pay this money back at the end of June, but we're going to end up accruing 3 months worth of interest at that. What was it, 16% interest rate? No, nobody would do that, okay? But anyway, let's just go ahead and let's see how that shakes itself out for the rest of the problem. So what happens? Now we have our cash collections for May. That came from our cash collection budget. Our cash disbursements, materials, labor, overhead, administrative costs, right? The cash portion of all those. That gives us total, what? Disbursements of $400,000. So we're going to end up with 30,000, perfect. Perfect. We're ending up with 30,000 at the end of the second month, right? Of course, nothing works that way either, but we would end up with that 30,000. Okay? Then what? Then we get into June. June now we have what? We start, and notice guys, we start the next month, whichever the balance was, which was 30,000 at the end of May is what we start with June, okay? And so what happens? We start with the 30,000 cash collections, disbursements that we've seen several times now. We're going to end up with cash of 95,000, are we? Okay? But what happens? Oh, this thing's kind of annoying here, this little thing. See the equipment purchase of 48,300? Oh, it's here. No, it's not here. They cover it up with this stupid thing. But see the equipment purchase of 48,300 right here? So we got that equipment purchase coming in too. And so what happens? We go ahead and we didn't have dividends this period. This is the dividend period we should have paid dividends. But anyway, we have this 95,000 cash. We repay the loan because we repaid it on June 30th, didn't we? And since we have to repay the loan, we also pay the interest. 50,000 times 16% times 3/12 means we got to pay out 2,000 of interest as well, right? Okay. And so now we've got this cash disbursement of 52. We end up with 43, and that's what we'll end up with, obviously, at the end of the quarter, right? Okay. Okay, so we have our cash budget, and then we can turn those into accrual financial statements. And this is the part that I'm not going to hold you accountable to. It's simply taking our sales times the number of units, our sales price per unit times the number of units. Remember that $4.99 per unit times the number of units we sold is going to be our cost of goods sold. That gives us our gross margin. Then we take out our selling and administrative expenses. The cash was $230, but remember I pointed out to you the accrual was $260. So we're preparing what? Accrual statements here, aren't we? So we take that out. That gives me my operating minus my interest expense. Gives me my net income. Then, you know, the problem's got to tell you about other assets, etc., that they have. And look, the reason I'm not so interested in all these things is the retained earnings is sort of the plug that they put in to make any example that they give you work. Right? So they'll just go ahead and tell you what the retained earnings is, and they just make up all these other numbers around this. So now you just start putting in numbers. We know we're going to have 43,000 cash. Our accounts receivable was 75,000. Remember, we're going to get 25% of that next month of the previous month's sale. And the next month, we have our raw materials ending inventory balance. If that was that, remember they said it was an assumed number? And I was like, I don't know where they got that assumed number from, but they got it times the 40 cents. The 5,000 units, that's to give us a head start on July, so that's our finished goods. Inventory is $4.99 a pop. Then they told us the land, the equipment, that gives us total assets. And then the accounts payable, it's the June purchases, of which we'll pay 50% in July. They told us the common stock. Retained earnings, and you're saying, well, John, that previous slide said it was what? 146,150, right, but then what? Then we had the net income from our budgeted income statement minus the dividends that they were planning to pay in, what was it, in June when they were planning to pay that? Okay, and so that gives us the ending balance of retained earnings, and you got your budgeted balance sheet. Okay? Question? Okay. So let's go ahead then. There's your buddy. She's your buddy because when you see her, that's the end of the slides, right? Okay. Okay. So let's go ahead and get rid of that. And what I'm going to do is I'm going to sit here and I'm going to go through maybe 3 of these, and then you're on your own. Okay, and you can just go through. I'm not going to go through every single one of them because you don't learn by sitting here watching me do these kind of problems. Like I said, they are reading comprehension problems. You got to sit there, read, understand, do what the problem is telling you, and watching me and do them is, is of little use to you. Okay, so I want you to spend the balance of the time, if you don't have to do it here, working through these, and then when we come back on Monday, we'll go through all of them to make sure there's not any questions on them, and then we'll pick up chapter, 8? Okay, but I need you to practice with these more than me sit here and just do them for you. Okay, so let's just go ahead and let's take a look at these, and we want to know the cash collections in June, right? Okay, and so cash collection in June, and you go with the easiest one first. If I'm sitting here and I'm looking at June, right, I'm going to get some money from what? From June sales. I'm going to get some money from what? May sales, and I'm going to get some money from April sales, right? Okay. So my June sales, they tell me are 120,000, don't they? I mean 110,000. Okay, so I read the wrong number here. Okay, you guys always want to kill me for sitting here writing and doing this at the same time. And then when you get up here, I'm supposed to be all nice to you. Okay, so 110,000. Okay, and what? That's going to be times, and how much are we going to get in the month of sale? Oh, in the month of sale, what? 25%. So in the month of sale, it's 0.25. So 110,000 times 0.25 for June should be what? $27,500. Okay, thank you. Okay, good. So my May sales are how much? 100,000, and they tell me that what? I'll get 65% in the month following the sale, so June follows May, right? So in June, I should get what? I should get 65% of May. So what's that, 65,000? Right? And then they tell me that I get what? 5% in the second month following the sale. Well, you have June, May, what? June follows May, and June is the second month following April, isn't it? Right? So that's April. So April is going to be, what's my sales in April? 120? Times what? Times 5% gives me what? 6,000? Okay, good. And you add all those up and you get what? 98,500, I hope? $98,500, that number right there, since I can't ever seem to write a comma in the place I want it to be. Okay? I mean, this has really very little to do with accounting. This is reading comprehension, isn't it? I mean, do you notice we're not saying, and debit now this and credit now that, right? Okay. Okay, good. How about this one? This one is trying to get me to what? To the units, isn't it? Okay. So the number of units we would have to manufacture during the year would be what? Now, they tell us that they plan to sell how many units? 480, right? So the way I do these guys, and I think the problem has something else down here, and I would not look at that because to me that's not helpful. I'm sitting here and I'm saying, well, I know I have to sell 480, so I'm going to start myself off with that. Got to have 480, right? Right? Okay. And then I want to have a certain amount of ending inventory available, right? And they're looking and they're saying that they're hoping that the ending inventory is how much? 50,000. So I'm going to add the ending inventory. I add that 50,000. That means I have total needs of what? Total needs of 530. Good. Okay, and then I got to do what? I've got to realize that I would have had some inventory on hand at the beginning of the year, right? So I pick up my what? I pick up my beginning inventory of my finished goods. So I subtract off less my beginning inventory because I already had that to start the year, didn't I? Of what? 80,000. And so when I back out that 80,000, I get what? 450? Okay? If you're waiting for deeper meaning, stop. That's it. Right? That's just the process you go through. Once we sit here and we know that we have the units, now we can figure out what our raw material needs are, right? Now we can figure out our labor costs, etc. Okay? The way I'm going to test this, though, guys, is what? We're going to test it sort of a chunk of the budget at a time, right? We're going to ask you units. We're going to ask you what's the amount of purchase. We're not going to make you say, now that you know this, now give me the labor budget, da-da-da. It's not going to flow like that. Each problem is going to be standalone, and we're going to be asking you different chunks of them, right? Okay? Okay, good. What was the other one I wanted to do here? Yeah, let's do this JT department store. Okay? Okay, good. Okay? So, and if you're wondering why the weird numbers, that's just where I pulled them from the test bank, and I just didn't always want to get rid of the numbers. So if you're saying, why is this number 44? We really worked through 44 questions already? That's just because that's where it came from the test bank, and I just trust me, it's like a half-hour involvement for me not to bring the number over from the test bank, and so I'm just gave up, and I'm just bringing this stupid number over. I'm not going to mess with it. Okay? All right, so that's all. That came over from the test bank. What you should be happy is that I'm giving you problems from the test bank, which means that there's maybe one right next to this that's going to be on your test, right? Okay? Okay, so we come over and we take a look, and I'm going to do this a little different than the way the solution did it. The solution tells, the problem tells us the cost of goods sold is 60% of sales, and then this problem goes and gives us the sales number, right? And what the book does is they keep turning the numbers into the 60%. That to me says you are one click away from making a mistake, right? Because you're going to say 60 and you're going to put 0.06 in there, or you're going to put 0.6 in your finger instead of hitting the 2, it's going to hit the 8, or something stupid like that, right? Okay, so I like to do just one calculation of 60%, right? Okay, so let's just take a look and see how we'll do that. And they're asking me for what month? For August, right? So I start with the sales. Sales for August is what? 580? Somebody just stomp on their calculator. That's it. I've had enough. 580? Okay. Then what? Then they tell us that I have a desired ending inventory, and my desired ending inventory is going to be what? 20% of the next month's sales, isn't it? So what am I going to do? Well, next month after August is September, isn't it? So I'll take that 620,000 times what? 0.2 means that before I've figured out my cost complement is going to be 124,000. I'm going to do one calculation for the 60% at the end of this problem. You turn the whole thing into the 60% after you figure out what your desired sales are. My cost is 60%. Okay? So I go ahead and I take the 580 and I have total needs of what? 704,000. That's my total needs. 704,000. And then I have to figure out, well, what was my beginning inventory? And this is a common mistake. Usually people want to say, well, your beginning inventory should have been what? 20% of the 460 for July? No, my beginning inventory was 20% of what? Of my August number, wasn't it? That's what I wanted to start August with. I wanted to start August with the 20%. So I'm going to take what? For the beginning inventory, I'm going to take 580,000 times what? Times 20%, so that I started out the month here with what? 116,000? All right? So I started the month off with that, so I subtract that. 704,000 minus the 116 gives me what? 588,000? Hello? 588,000, and now I'm sitting there and I want what? I want 60% of that, don't I? Because my cost is 60%. So when I multiply that by 0.6, now I get the cost of that, which is what the question was asking for, which is what? 352,800? Right? So I did everything at retail. I did the whole calculation at retail, so that I just have to make one calculation to turn that into a cost number, right? Distributive law of multiplication. I did all the work inside the parentheses using the 100%, right? And then outside of the parentheses was 60%, right? And I just multiplied the thing by 60% at the end, and I got the same answer, right? And I do that because otherwise it's too easy to make a mistake. 0.6 times 0.2. Got to take a number, times 0.6, take that same number, times 0.2. That's when the house starts to fall. Okay, so I don't like to do calculations like that. I like to, if I'm going to be making, I don't like to do percentage calculations inside of percentage calculations. So I like to just set them up and then do one chunk on the 60%, whatever the cost complement is. Okay? Okay, good. Let's do one more. And then we'll get out of here. You guys, when I say get out of here, I highly recommend, and you can work them together if you want, but I really think you need to, actually, I wouldn't even work them together. This is like one of these things like, I'm trying to think of an analogy. Some things you just got to do by yourself. This is like jogging. I never understand. I see people jogging together. I'm like, how do they do that? I mean, if I jog, it's like, oh, please don't have a heart attack. Please don't have a heart attack. I have to keep saying that to myself over and over again. So anyway, it's wiping my nose with my sleeve and stuff, So anyway, okay, like you needed to hear that. Okay, all right. So anyway, this is like, some things you got to do by yourself. I don't know how else to put it. That's when you really get it. So I want to sit here and I want to do a labor one. Where's my labor one that I wanted to do? Okay, I think it's this Milano is the one that was going the way I wanted. And I'm just going to show you the answer here because I would answer it exactly the way they are, and there's no point in me writing something separate, okay? So Milano Corporation is working on its direct labor budget for the next 2 months. Each unit of output requires 0.5 direct labor hours. The direct labor rate is $9.80 per direct labor hours. The production budget calls for producing 6,400 units in October and 6,300 units in November. The direct labor workforce is fully adjusted to the hours needed for the month, right? So this isn't giving me a minimum number of hours, right? So I just got to pick up whatever they give me as the hours. And then this becomes a piece of cake, right? Once you realize that, you just take the number of units production times what? Times the direct labor per unit gives me the direct labor hours needed times the direct labor cost per hour of 980. This question is too easy. Huh? I got to tell you, you're asking that, and when I looked at the questions for the final, I was like, yeah, okay, this is perfect. This is nice and easy. So I'm thinking the final's pretty easy for these questions. They're sort of like this. They just want to see, no working backwards through anything to come up with numbers. No, well, now you got this, so you got to do that kind of things. It's what? Very straightforward. So far of the 2 chapters we've talked about for the final, and that's why I was yelling at you guys the other day when I think you were listening, because that chapter 6, that's the one that absorption versus variables is the one that you got to think about a little bit more, because nobody walks around saying, hey, man, did you hear about the difference between absorption and variables costing? No, what is it? Well, the way we treat fixed manufacturing costs is all the difference, man. Let me show you. Nobody ever talks about that. And so as soon as you walk out of this class, I promise you that concept will evaporate. It'll be gone. Because there's no point to it. It's like, okay, where it becomes an issue is if you were trying to set up a company's cost accounting system, and you had to set up the system so that it would generate a set of contribution format statements, right? Because if we're a big company and we're going to be distributing those all kinds of different departments, we're going to have a system that generates those statements relatively systematically, right? Fairly systematically. And so what happens? We'd have to set up a cost accounting system that would gather those costs in the manner that we studied there. But, they act like everybody in the world's going to walk in somewhere and start designing cost accounting systems. Meanwhile, the reality is that if you're not an accounting major, you're not going to do that. If you are an accounting major, you're most likely going to enter into what? Enter into a financial accounting situation where you're not putting together a cost accounting system. And if you do, you're the small percentage of people that find yourself in a situation where you're doing a cost accounting system. That system is going to be highly specialized, and they're going to teach you everything you need to know from the very beginning. So that's why I feel like we go way overboard on variables versus absorption. Now, someone could argue, well, John, but they're going to need to know that when they go to take cost accounting at the university. Yeah, I've taught cost accounting at the university, and I have to teach that all over to the cost accounting students, because everybody forgets it as soon as you walk out. And you say, well, okay, but what about the CPA exam? I have to teach it again to my CPA students, because nobody remembers that. So there's no point. Okay, anyway. All right, but cut, delete. Okay, so let's look at this one. Okay, and this one to me is more interesting, and I want to just show you how that sort of minimum number of hours works. Okay, and then we'll get out of here on this. Okay, so Maury Corporation is working on its direct labor budget for the next 2 months. Each unit of output requires 0.75 direct labor hours. The direct labor rate is $8.10 per direct labor hour. The budget production calls for 2,000 units in March and 2,300 units in April. But the company guarantees its direct labor workers a 40-hour paid work week. The number of workers currently employed, that means, geez, what do they get paid by the word for this question? That means the company is committed to paying its direct labor force at least 1,760 hours. Couldn't they said that in like 50,000 less words? So we have a guaranteed of what? 1,760 direct labor hours in total each month. Even though this is not enough work to keep them busy. Holy Toledo, this person was lonely when they wrote this. Okay, so what would be the total combined direct labor cost for the 2 months? Okay, so after all that, we go ahead and we have what? The required production. It requires what? 0.75 a piece, doesn't it? That's 1,500 for March, 1,725 for April. But what happens? Both of those are under the minimum, so we bring the minimum down, don't we? Now, instead of writing all those words, this person would have been better off to have written this question to teach us more, to have it so that what? So that maybe April, the hours were 2,000 hours. And if it was 2,000 hours, we would have done what? We would have brought down the 2,000, wouldn't we? So it's what? Whichever's greater, the minimum hours or the needed hours, right? Whichever's the bigger number. Okay? But once you get past that, these labor questions are a piece of cake, aren't they? Just multiply that by the labor rate. Okay? Questions? Okay, guys, I'm going to go ahead and turn you loose rather than us sit here and do all these together. We will pick them up on Monday. Guys, don't walk in here on Monday and go, okay, show us. Okay? Be ready to do these, so if I call out on you, you can do them. That'll take us, maybe about a half hour, 45 minutes at the beginning of class, and then we'll jump in and we'll get into chapter 8, okay? Okay, guys, see you on Monday. Am I busy tomorrow? I'm busy every day.
Can you
What's
help
it?
me? So I basically handle all the accounts for all of the student activities departments, but I really suck at this, and I don't know if I'm like doing this right. And I feel bad like bugging my advisors all the time because they're like
Sure.
hella
You want to just put
busy.
it up here?
Yeah.
Okay.
Like I don't know like how I can make it more like organized, I guess. Or I don't know.
Well, the first thing I see, if you're saying this was my budgeted,
Mhm.
wouldn't you have a column for actual? And then I would do a variance column over here.
Okay. So by actually you mean like how much is left in the account or how much is
So you have a beginning balance in the account, right?
yeah.
So you could do that. You could say beginning balance.
Uh-huh.
Um, you could put receipts for the period.
Okay.
That would give you available.
Okay.
And then subtract the ending balance. That's the amount that was used
Yeah.
out of the account. And then that's your actual.
Okay.
And then the budget is whatever the budget was. Now, you don't have to bore them with beginning balance.
Yeah.
If you don't want to, you could just use that part for your calculations as to what was spent out of the account for the period.
Yeah.
Or if you just want to put the total debits to the account for the period. I don't know if you're using double entry.
No.
Okay, so
It's
since you
just I just have to keep track of the account so that like when it's brought up in council I have the numbers like available.
right,
If that
so
makes sense.
so what I would do, excuse me, so what I would do is I would go ahead and for your purposes, okay, and you can do this with them if depending on different councils or different levels of detail, and there's no standard as to how you set something like that up. But if you have the beginning balance in the account, right, and then you have the amount of receipts that came into the account. So say beginning balance was 50,
Yeah.
right? Receipts that came into the account we'll say is 100.
Okay.
Okay, and so available in here obviously is 150, right?
Yeah.
And let's say the ending balance is 40,
Okay.
right? That means that the disbursements were 90, right?
Yeah.
Okay, in this example.
Yeah.
Okay, the disbursements were 90, and that's your actual disbursements, right?
Yeah.
And if the budgeted was 100,
Uh-huh.
then you can just put budget. Of course, I'm going to run out of room.
That's fine.
You
Yeah. Yeah.
you'd have budget, and budget was, well, we would have actual. And you could start the report here, or you could have the reports, for detail and put the other one behind it in case somebody wants to see that. Okay, but then you could say actual disbursements was 90, okay, and budgeted was 100. And what I would actually do is I'd put the budget first
Okay.
was 100 and the actual was 90. And so the variance, if you really want to show off,
Be 10.
would be 10, and you can put, even if you wanted to, in parentheses, favorable here.
Okay.
If you wanted to be kind to them, if you wanted to be, hey, get with it. If it's a positive number, it's positive. it's a favorable, and if it's negative, it's unfavorable,
Okay.
right? Positive, favorable, negative, unfavorable.
Okay.
Okay, so if you sat here and the budget was 100, and after you did your analysis, say for month 2, and this was showing, 130, well, now that's going to be a negative number,
Yeah.
and that's going to be unfavorable. And you could put, if you want, unfavorable.
Okay. So like basically our budget is like I would have like 20 accounts, like one for like student activities, one for like travel, one for like money request or whatever. And so I don't think I don't think we get like receipts. Like we don't add money to them unless if we do transfers. Would that count as a
Where's the
receipt?
money come from?
It's from student activities fees. So like that's like our income for all of it, and then through that we allocate it like at the end of the year before the next academic year. So
Okay.
then like if there's no receipts, what I just don't put that.
Well, if you're telling me, well, I don't understand. You're saying that you have to have money coming from
Yeah,
somewhere.
so like
But you're saying that
so I'm
when
basically keeping track of so like if we have so let's say last year our council agreed on a budget, right? Of this amount per year. So like that budget it reflects how much is in that account for the next year. Right?
right, so you know you're going to have $1,000 coming in,
Yeah.
and then you allocate it to the different activities,
Yeah.
line items, right?
Uh-huh.
Okay. Well, that allocation
Is the receipt.
Well, that allocation then must have been on some percentage. I mean, you can calculate the percentage, whether you did a percentage or not. If somebody got 100 of that 1,000, then they got 10% of what the budgeted receipts were, right?
Yeah.
Okay. So then, if you know at a sort of
Oh,
GL level what the actual receipts were, then you just allocate it based on the budgeted
Okay, so
percentages
you're saying from like the total income, like receipts would be the percentage of that income? Okay.
for each one of the line items based on how the budget was, right?
Yeah.
And now you're comparing apples to apples.
Okay. All right. Thank you. That
Yeah.
helps.
Yeah.
I know, because I wrote like a really shitty one, and I was like, I don't want to.
Yeah, I mean, this is sort of a standard, and it sounds like that if the committee was involved in allocating to the line items, you're probably, what I would do in your presentation, I'd start them with this,
Okay.
and then I would refer them to the supporting page that shows, how you got to basically the disbursements for each one, but don't walk them through each one because then everybody goes to sleep. Yeah, so you say for the first couple of them, okay, here's the disbursements, and then you say, and if you look at page
Yeah.
2 now, here's the outcome of each one of those. So they can see, oh, I see the disbursement. I see how she got the disbursement.
Yeah.
That's my actual column. And you would explain to them how you allocated the the total receipts. Well, you'd have to explain how you got the total receipts to each one using the previous budget. So you'd explain that, show them for a couple. Now they see, now you're only down to this line item of this sheet,
Yeah.
and it's the disbursement, and they know where the budget comes from because they're the ones that did it, and now they can look and see, well, what happened here? Jarna, were you dipping into the funds? Whatever it is that they want to say.
That was my other question. So is it bad to move, like transfer
Can
money
I,
from one account to
can
another?
I make sure I stop this?
Oh.
I need to pause this. Now they got our whole conversation on here.
Was it on?
Yeah, the whole thing was on there.